What's up, everyone, and welcome back to the Web3 Daily, where we dive into the big moves happening in our space. First, let's take a look at the market. Honestly, the vibe today feels like that eerie calm after a big storm, but you can tell there are still some serious undercurrents. Bitcoin and Ethereum seem to be locked in a tense tug-of-war. Right at a critical level, the bulls and bears are just going back and forth, testing support and resistance. Trading volume has noticeably dropped off, and it feels like everyone's holding their breath, waiting for a clear signal. This kind of sideways action can be a real grind. It feels stuck, not really going up or down, and it's a huge test of patience. The sentiment in the community has definitely shifted from that intense FOMO to more of a wait-and-see approach. I mean, that massive liquidation event a couple of days ago wiped out a lot of high-leverage players and made the entire market a lot more cautious. In times like these, keeping your hands in your pockets might be the smartest move. The market is risky, so it pays to observe before you leap. But a piece of news today that I think is truly a bombshell, the one with massive implications, actually comes from the regulators. When I first saw it, my reaction was, whoa, this is a big deal. The CFTC, the US commodities regulator, has officially put forward a proposal to allow market participants to use stablecoins as collateral for derivatives trading. Now, let that sink in for a second. What does this really mean? It means that in the eyes of a top-tier US regulatory body, stablecoins are no longer this shady gray area product that needs to be contained. They are being treated as a legitimate financial instrument that can be integrated into the mainstream financial framework. Just think about it. Before, when you traded futures, your margin was either in cash or in volatile assets like Bitcoin or Ethereum.
If you can now use compliant stablecoins directly, the improvement in capital efficiency, especially for institutions and market makers with huge volumes, is absolutely immense.
The most fascinating part of this whole thing is the stark contrast with the SEC's hostile to everyone stance. You have one agency building walls while the other is building bridges. It feels like we're watching a Game of Thrones for regulatory control over the crypto world unfold within the US government itself. This move by the CFTC is like hitting the gas pedal hard on the road to stablecoin regulation, and it's also a clear signal that they want to firmly control this piece of the pie. So, don't get bored by the sideways market today. Fundamental infrastructural shifts like this are the real catalysts that could ignite the next bull run. Alright, speaking of mainstream integration, let's shift from the regulators to the giants on Wall Street. Because their actions often speak louder than words, we got some major news out of the blue today. Morgan Stanley, a name everyone knows, has officially decided to offer cryptocurrency investment access to its clients through its E-Times trade platform. Now, let's get the details straight. They're not offering direct spot purchases. Instead, it's indirect exposure through futures and related securities. Some people might say, oh, it's not spot, so it's not a huge deal. But I completely disagree. You have to realize this isn't just some small-time brokerage. This is Morgan Stanley, a true Wall Street behemoth. For their millions upon millions of traditional investors on that platform, the friction and psychological barrier of signing up for a crypto exchange and managing private keys is massive. Now, right inside the stock trading app they've used for over a decade, they can get exposure to Bitcoin, Ethereum, and even Solana with a single click, just like buying a stock. This is a critical step in bringing crypto assets to the masses. It solves the fundamental problem of how do I even get in? And did you notice? The list includes not just Bitcoin and Ethereum, but also Solana. This tells you that in the eyes of Wall Street's top-tier portfolio managers, Solana has firmly secured its spot in the top 3. Its ecosystem and performance have earned the institutional stamp of approval. For Solana's long-term narrative, this is an incredibly powerful endorsement. So, if Morgan Stanley represents the outside giants trying to get in, our next story is about how the top crypto-native players are leveling up their own game from within. The publicly traded mining giant CleanSpark just announced that they've secured a $100 million line of credit from Coinbase Prime. Now, the most interesting part of this deal is the structure. CleanSpark is using the Bitcoin on its own balance sheet as collateral to borrow US dollars to grow its business. This is a universe away from the old model we're used to, where miners had to immediately dump their newly mined coins on the market to pay for electricity and new rigs. So what's the advantage here? First, CleanSpark doesn't have to sell its Bitcoin at a time when they believe the price will continue to rise, allowing them to capture that potential upside. Second, they immediately get a huge injection of cash to expand their operations and move into new ventures like high-performance computing. This event is a clear signal that the Bitcoin mining industry is evolving from the old crude mine and sell approach to a much more mature and sophisticated phase of financial operations. The top mining firms are behaving more and more like traditional energy or tech companies, understanding how to use their balance sheets to play the capital markets. And the fact that Coinbase Prime is willing to provide credit at this scale shows just how robust the institutional-grade crypto financial infrastructure is becoming. Alright, so we've covered the big league plays by institutions and miners. Let's zoom in now to something more relatable for all of us. Payments. At the end of the day, for an asset to truly go mainstream, it needs to integrate into daily life. The news I saw today is that a fintech company called Fold has partnered with the absolute titans of the payment world, Visa and Stripe, to launch a Bitcoin rewards credit card. Simply put, wherever you can use a Visa card, whether it's buying coffee or paying your internet bill, you can get up to 3.5% back in Bitcoin. When I saw this, one phrase immediately came to mind: Trojan horse. And I mean that in the best way possible. Why? Because this strategy is brilliant. It completely bypasses the entire complicated learning curve for the average person to acquire Bitcoin. You don't need to understand exchanges or wallets. You just use this card for your everyday purchases, like any other credit card. And Bitcoin automatically accumulates in your account. It's a frictionless way to stack sats. It shifts the focus from actively trading crypto to passively earning crypto through daily life. The potential for a model like this is immense. It transforms Bitcoin from an intimidating asset that requires active investment into a simple byproduct of consumer spending. When that scales, and millions of people become Bitcoin holders without even trying, you are going to see a fundamental shift in the entire market's user base and consensus. We've been talking a lot about Bitcoin's mainstream integration, but as we all know, narratives in crypto are constantly rotating. After the spot Bitcoin and Ethereum ETFs finally landed, the big question has been who's next? And recently the answer seems to be pointing overwhelmingly towards Cardano, or ADA. Now, nothing is official yet, but market expectations have already been driven to a frenzy. I took a look at the prediction market, Polymarket, and the contract for spot ADA ETF approved by October 26 has skyrocketed to over a 90% probability. This is way beyond simple community rumors or speculation. This is the market placing serious real money bets that this is going to happen. So, why Cardano? And why now? I think there are a few reasons. First, its community consensus is undeniably strong, with a massive global user base. Second, from a regulatory perspective, Cardano has always taken a more measured and clear path, which might make it an easier pill for regulators to swallow. But the most critical factor is that the market needs new narratives. With the Bitcoin and Ethereum ETF stories largely played out, capital is desperately searching for the next catalyst to ignite market sentiment. And ADA, with its market cap, community engagement, and a technical story, is a perfect candidate. Therefore, regardless of whether this Cardano ETF ultimately gets the green light, the hype cycle itself has already kicked off an arms race for major altcoin ETFs. Get ready to see Solana, XRP, and others start competing fiercely in this arena. Alright, so we've talked about narratives at the asset level. Let's shift our focus back to the technology layer, to the fierce competition between the public chains themselves. Because while ETFs are about hype, what really keeps users and developers around in the long run is raw performance and the user experience. On that front, BNB Chain just made a major move. They've launched a performance enhancement plan codenamed BEP 333. The core objective is twofold: to slash gas fees by another order of magnitude and to cut block times down to just 1 second. What does that mean in simple terms? It means transactions on the BNB chain are about to become nearly instant and so cheap they're almost free. When I saw this news, I could practically smell the gunpowder. The competition in the public chain space, the L1 wars, has reached the boiling point. On one side, you have Ethereum and its army of layer 2 solutions evolving at a breakneck pace. On the other, you have native high-performance chains like Solana nipping at their heels. For BNB chain to announce such an aggressive upgrade at this moment, their goal is crystal clear. They are defending their throne as the king of user traffic and sending a message to the entire market that says, we don't just have the users, we have the performance to compete with anyone. This is more than just a tech upgrade. It's a strategic battle for ecosystem survival. They're aiming to leverage extreme cost efficiency to attract the next wave of GameFi, DeFi, and SocialFi projects and solidify their foundational ecosystem. And for our last piece today, let's talk about a fascinating meta trend I've been noticing. Have you felt it too? The lines between the crypto market and the stock market are blurring more than ever, especially when it comes to publicly traded crypto companies. We're seeing this powerful, almost bizarre feedback loop between coin prices and stock prices. I mean, just look at recent events. When Strive and Assembler merged to create that massive Bitcoin treasury, their stocks went absolutely parabolic. Or take back they appointed a single crypto veteran to their board, and the stock ripped 40% in one day. That kind of reaction to that kind of news is almost unheard of in the traditional stock market. So what's really going on here? It's Wall Street finding a compliant and easy proxy to bet on the crypto space. For many of these large traditional funds, buying spot crypto is a compliance nightmare with operational headaches. But buying shares in a Nasdaq-listed company, that's business as usual. As a result, these stocks have become a barometer, and more importantly, an amplifier for crypto market sentiment. When crypto sentiment is bullish, money flows into these stocks. When these stocks surge, it feeds right back into the crypto market as a sign of confidence, attracting even more capital. What's the takeaway for us? It means we have to expand our playbook. In the future, it might not be enough to just analyze a token's fundamentals and its price chart. We also need to pay close attention to the public companies in the space, their stock performance, their M&A activity, because they are the bridge to the vast ocean of capital in traditional finance. The crypto world is definitely not an isolated island anymore. Alright, that's a wrap for today's Web3 Daily. If you found this helpful, do me a favor and hit that like button to show some support. Every day, we're digging through the noise to bring you the most critical, high-signal information in the Web3 world, the stuff that's closest to the money. The goal is to help you cut through the hype and make smarter, more rational decisions on your investment journey. Also, I've dropped exclusive sign-up links for major exchanges in the comment section below. These are special high rebate deals we've secured for our community to help you save on fees. Let's all stay rational, move steady, and get rich slowly here in the Web3 space. May your crypto portfolio grow steadily, and I'll see you all tomorrow.